Hello friends, this is Vijay Bhambwani and I'm back with you in the 55th edition of the weekly market outlook videos. Now in this video, I'm going to emphasize upon what should be your plan of action in the week ahead because the market has seen the kind of declines that they have seen in the last 2 or 3 trading weeks, and in the end of this video, I have recorded a special segment on what I have done, what I would suggest you should do. You can agree to disagree, but this is what I have done and I'm keeping you abreast of what you can do going forward. So let's plunge right in, and coming up on your screen is the market roundup window, which shows the bank Nifty underperforming the Nifty 50 because of all the familiar reasons which my viewers are well aware of. Inflation, dollar index, etc. We are going to take all this as we go along. So bullion, which is gold and silver, fell due to a strong dollar, and oil prices were also falling. Now, cheaper oil eases the worries about inflation, and therefore gold and silver were expected to fall. Natural gas flared up due to the geopolitical football being played out in Europe between Russia, Belarus, Germany, Norway, and a whole lot of other players. I've written enough about this geopolitical football on my social media accounts. Feel free to connect with me on those accounts. My contact coordinates will come at the fag end of this video. The US dollar index, or the Dixie, flared up and pressurized emerging markets, including India. Now, the rupee, on the other hand, rose against the US dollar, which makes the rupee a relative outperformer versus the dollar. Bond yields eased because buying was seen last week in bonds. When the prices of bonds go up, yields come down. I'm a big believer in the bond markets, and people who understand this asset class, I believe, have a clear edge against those who don't. Now, the National Stock Exchange, the NSE, lost 1.24% in market capitalization. This is the value of all shares listed on the NSE, which saw erosion to that extent. Now take a look at the MWPL, or the market wide position limit chart on your screen, which shows week on week basis gain, but it fell slightly on Friday. Usually, declines in MWPL come in the last week of the derivative cycle. But this development, seeing the overall market-wide position limit falling on the last day of the week, is a small red flag, the first red flag of this week. Now, this figure is something I update daily on my social media account, so do connect with me. My contact coordinates at the end of this video. Now let's take a look at the basis chart, which shows on your screen. This is the futures premium versus the spot, which was marginally lower on a week-on-week basis due to the selling pressure. That, of course, is obvious. Now take a look at the index and stock futures cumulative volumes of November, December, and January series. This volume figure shows higher levels, partly because the week prior to this was a holiday week and therefore the figures were expected to be lower. But the fact that volumes rose tells you that traders participated in the drawdown or the decline in the markets. Now let's turn to the most revealing, the most reliable studies we've shared with you so far from our in-house statistical trading model, the IBEX, which is the impetus chart. Pay particular attention to this chart because it's flashing a danger signal you simply cannot, I repeat, cannot ignore. The impetus chart was seen rising last week when indices were falling. The bank Nifty in particular was seeing a relatively bigger fall in the impetus. That shows the selling was gaining momentum or velocity. Ideally, for a bull move in the markets, prices and impetus must rise together. Here, unfortunately, last week we saw the price falling and the impetus rising. In the week ahead, either the prices rise as soon as possible or you could expect trouble for the bulls. Now, this, my friends, is the second red flag I'm seeing so far. Watch this study very, very carefully in going forward. And now I take you to the footprint of the 4 different types of traders who are playing in the market. We check out the FII footprint first. Their index futures net long positions went to 13,825 lots as against 24,032 lots last week, which means the FIIs have actually reduced their net index long positions. Where their individual stock positions are concerned, their individual stock futures shorts rose to 96,488 lots against net short of 94,906 lots. So they are stepping up their short positions. Not a good sign. Let's take a look at DIIs, the domestic investment institutions. Their index net shorts fell marginally to 73,886 lots against last week's 76,783 lots net short. So they've cut short their index shorts marginally, maybe booking profits. Now, their stock futures shorts have actually fallen a bit too, to the level of 15,45,006 lots as against last week's 15,54,511 lots. Let's take a look at prop traders, very critical aspect of the market. Now, these are second best after the insiders, because these are brokers' own trades. They know who's buying, who's selling, what price and how much. So they tend to basically reflect a second best thing to insider trading. Now, these guys, the prop traders, raised their index net long positions to 12,081 lots, which last week was 5,973 lots net long. Where their stock futures are concerned, now this is a revelation. Now, where their stock futures are concerned, they cut their individual stock futures longs to 2,29,652 lots, which last week was 2,51,230 lots. Let's come to retail. These are guys who've been doing all the heavy lifting and have taken the market to where it is right now. The retail guys have seen their index net long positions rise to 47,980 lots, which last week was 46,778 lots. Where their stock, individual stock futures net longs are concerned, they have stepped up their net long positions to 14,11,842 lots from last week, 13,97,387 lots. Friends, I consider this as a red flag. The reason being that individual retail traders have basically taken on a lot of long positions, which is a lot of risk, and technically, historically, they have been the weakest segment of the market. Now, whether they can bear the kind of mark-to-market loss that they have seen in the last few weeks and maybe in the weeks going ahead is something prices will tell us, but this is definitely a concentrated net long position in the hands of the weakest segment in the market. Now, this is a red flag that you must keep in mind. Now, my friends, let's go to the bond market. The 10-year benchmark bond yield fell because bond prices rose. Flight to safety was seen. Note how the media carried a release about how Reliance Industries ventured fresh investments. They already have investments in the bond markets, but they stepped up their investments in the 5-year bonds. May I remind you that I warned you last week that the opening up of the retail direct G-Sec segment will lead to pressure on banking stocks and the bank Nifty itself, and see what happened. With a huge weightage in the Nifty, bank stocks pulled down both the indices. proving my hypothesis highly accurate and far ahead of the consensus in the markets. Now, friends, bond markets are the source of finance for other markets, including governments the world over. Yet, traders tend to think equities are the only game in town, and not for us. Definitely not for us. We believe in staying ahead, and therefore we include bonds in our metrics, in our statistical trading model, and we watch yields carefully every minute of the day because they'll determine trends in equities, commodities, and even currencies. So if you're looking for a hidden lever that moves the market, basically bond markets are that lever. Now, there are two types of investors and traders: those who understand bonds and those who do not. Bond convexity specifically, if you Google search bond convexity, you'll know what I mean. Now, the guys who understand bond convexity invariably have a huge advantage where return on investment is concerned on their trades and investments over those kind of traders and investors who do not understand bond convexity. So please plan ahead. Plan on staying ahead of your contemporaries and the broader markets and learn all you can about bond convexity. Friends, let's now go to the US dollar index. Now, this is another aspect of the market that I have been covering from day one, and I've been telling you, do not neglect this aspect of the market. Now, this index rose on 3 out of 5 trading sessions, and it surged even on Friday, which is basically bad news for all emerging markets, including India, because it raises our import prices and triggers what is known as imported inflation. And for companies and countries that have forex loans, they take a hit on interest payments, which is servicing the loan, and even repayments because the dollar becomes more expensive. Companies that are net importers also take a hit on their bottom line. So I warned my followers via a free WhatsApp update in the morning last week about how the Dixie was behaving like a wrecking ball. A wrecking ball is a huge metal ball suspended onto a crane, and it hits buildings to demolish those buildings instead of laboriously tearing it down with a chisel and hammer. Now, this wrecking ball called the Dixie, I warned my followers, would demolish the bullish sentiments in the market in the absolute near term. Last week, I sent this message out, and what a prophetic expectation. It hit the nail on the head. If you choose to receive these free WhatsApp updates, please send an email to the above address. I'll add you on to the broadcast list. Please note, I do not send out any stock tips or your stock recommendations. All I do share is sheer broad-based gyan in the markets. So coming back to the chart of the Dixie, you will see that the Dixie is above its 25-day exponential moving average, which indicates a month-long holding on cost of the bulls. So the short-term outlook is now positive. The weekly chart on your screen shows the price above the 25-week exponential moving average too, which is a 6-month average price. So even the medium-term outlook is positive. The price has tested its highest after middle of July 2020, which shows that flight to safety in the US greenback was seen for the second week in a row. Emerging markets traders should be on high alert. This, my friends, is the third red flag for the week. Now, last week I advocated a range between 96.10 on the upside and 94.10 on the downside, which was more or less in place. However, the intraday high was 96.27, so we saw 17 bips overshoot on the upside. The price, of course, closed near the 96.10, which I estimated last week. In the coming week, I expect an estimated range between 97.10 on the upside and 95.05 on the downside. Watch this instrument with hawk eyes in the coming week because every asset class, commodities, currencies, equities will be impacted by the pull and push of the Dixie. Friends, let's now go to the Bank Nifty, which fell on 4 out of 4 trading sessions last week. And it stayed below its 25-day exponential moving average, which reflects the approximately month-long holding on cost of the bulls. This puts a tremendous mark-to-market pressure on traders who are holding longs. The cost of carry, which is the rollover cost from October to November, is not even reflected in the chart here, which is an additional negative. This is something that real-world traders who actually trade for a living will understand immediately. Last week, I said staying below the 38,500 level may open up fresh further downside, and that occurred according to my expectations. Let's move to the weekly chart on your screen, which shows a second consecutive fall last week. The price is still, however, above its 25-week exponential moving average, which reflects 6-month long holding on cost, which means the medium-term outlook, however, remains positive for now. Now, this average is expected to provide a rough and ready support in the near term. However, should this be violated, then the bulls are in for some serious trouble. Do note that this average will continue to rise daily even if the price is falling because the average is a lagging one. And the banking stocks, I remind you, have a high weightage in the Nifty. So if the Bank Nifty falls too much, don't expect the Nifty to remain untouched from the selling pressure. Last week, I warned you of pressure on banking stocks in the Bank Nifty due to the bond market, which happened. Now, here you go. Like I tell you on my social media accounts, I endeavor to, I crave to plan ahead. I want to remain weeks and weeks ahead of the broader market consensus. And I'm very happy that it worked out as the way it did. And we'll continue to keep you ahead of the market. Do connect with me here. In the week gone by, in the week before last, the index was at number 4 on the most volatile list, but it's fallen very sharply. Now, this is something you need to note. It's fallen 59 slots to 63 number 63 on the most volatile counters list. Now, that is a huge red flag. The statistical beta or the sheer price volatility in the individual stocks has jumped to a degree that they've left the Bank Nifty volatility behind. Now, this is the impetus of these stocks that have seen volatility jump on price declines have gone all the way to the moon, which is a huge red flag. Now, this is a red flag that is frankly enough to keep you awake in the night. If you're a statistical trader, if you're kind of watching the metrics, the kind of jump that I have seen on the gauges of individual stock impetus is not something that I have seen for a very long time. And believe me, I've been trading for 35 years now. Now, last week I advocated a range between 40,225 on the upside and 37,250 on the downside, which held perfectly. In the coming week, I expect an estimated range between 39,450 on the upside and 36,500 on the downside. I think you should trade light and hold your trades with stop losses because statistical beta or pure price volatility is elevated. So price swings will remain wild. A friendly reminder here, my friends, do stick on till the end of the video. There's a special segment towards the end here wherein I discuss a game plan with you. Now, friends, let's go to the Nifty 50, which fell 1.87% last week, falling on 3 out of 4 trading sessions. And it closed below its 25-day exponential moving average for the second day in a row. Now, this average, as I've reminded you time and again, reflects a month-long holding on cost for the bulls. And right now, the current market price is below their holding cost, which means there may be mark-to-market pressure if the price especially falls further and definitely below the 17,600 mark. So this is the 6th red flag for this week. Do remember that the impetus reading on Nifty and Bank Nifty was rising while the prices were falling, which means the falls are gaining momentum. This is another red flag. Now, we want the price to rise past the 25-day exponential moving average, and that too sustainably closing above it for the bulls to get a reprieve or a second chance. The 17,600 level is more or less a double bottom, a crude double bottom for now. Should the bulls manage to defend it, a pullback rally may be seen. If not, I would await for some more declines in the offing. Let's now go to the weekly chart, which shows a prominent red or a bearish candle. The price remains above its 25-week exponential moving average, which is roughly 6-month holding on cost of our bull. That means the medium-term outlook remains positive, however, only for now. Now, this moving average support must be defended in case of declines in the coming week. In the week before last, this index was at number 18 on the most volatile counters list, but it fell very sharply to number 112. Now, that's a big, huge decline. Now, this is because of the sky high, the gauge I told you of impetus, the sky high impetus reading on individual stocks. Now, that warns me about the possibility. Remember, I'm using the word possibility, that distribution is taking place at higher levels. Smart money is offloading shares. While it's premature yet to pull the plug and count it as a definitive sign, I would wait for the next couple of days and watch the 17,600 on the Nifty very, very keenly. A good, wise trader prepares for any eventuality in advance. So do sit on the edge of your seat. Last week, I advocated a range between 18,550 on the upside and 17,650 on the downside. And I'm very pleased to note that the weekly low was at 17,688 against an expected 17,650, which is 38 points above our threshold. Now, this validates the workings of our statistical model, the IBEX, so far. That's a huge sign of relief for us in my team. The coming week is likely to see an estimated range between 18,225 on the upside and 17,300 on the downside. Friends, I continue to advocate that you trade light with stop losses in place. There is a very fair degree of possibility that volatility may even be higher than last week, and therefore the ranges that I have advocated to you may be exceeded on the downside. Now, this is due to sheer beta clustering. This is something that statistical model traders will understand immediately, and I suggest you raise your guard and wait till the end for this video for a special segment that I have recorded for you in this while. Friends, now I come to the most popular segment of this video, wherein I recommend 5 individual counters with high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks with low beta, low impetus, wherein you take big exposure, wait for small price moves. Why the difference? Because different traders, different mindsets, and therefore different game plans. So let's begin with the high beta stock list, which is led by Biocon at number 1, number 2, Syngene, number 3, Apollo Hospitals, number 4, Escorts, number 5, Shree Cements, and the low beta list is led by Shriram Transport at number 1, number 2, L&T, number 3, RBL Bank, number 4, Dixon, and number 5, Eicher Motors. Friends, this hierarchy of high and low beta stocks changes day to day, maybe even hour to hour in highly volatile markets that we are seeing off late. So do connect with me on social media. I update all this kind of data at the end of the day, late evening, so you can remain updated and ahead of the curve. Now, my friends, I come to the special segment which I promised you. You see, amongst my people, there is an old belief that any kind of risky venture or business should be attempted only after you've set aside enough money So that in passive income investments, by the way, whether it is rental income coming in from properties or interest coming in from deposits or whatever it is, when you have segregated enough money in passive income sources which can run your house for you and not cut down any lifestyle expenditure, only after that should you basically venture out in risky investments. So the bond markets, being the fountain of supply of finance for all other asset classes, are a very good place. They are sovereign debt guaranteed by the central government of India. Even if there is a problem, the central government can simply print currency and repay the bond holders, which kind of assures you of return of capital. And the interest that you get on the bonds is return on capital. Now, why should you invest in bonds? They are so boring, right? The boring old bond market. Because when stocks dive, remember the stock markets fell in 2008, they fell by a whopping 67-68%. What if you had taken money out of the stock market and kind of placed it in the bond market or in the FD market? Remember, in 2008, you were getting about 8% return on FDs. So number one, you would have saved yourself a 67% pulverizing decline in your stocks. Now, 67% was only 67, 68, maybe a bit here and there, was only the headline indices. There are stocks that have fallen 80, 85, 90% also. So number one, you save your 80, 90% crushing decline in prices. Number two, you wound up gaining 8% interest. So how much were you ahead of your competitor, your cousin, your neighbor, your colleague or whatever? Massive. If the stock market was to hypothetically fall 30, 35% and you deploy money at 6.5% in bond yields, hey, you're 40% above or higher than the guy who was stubborn and thought equities are the only game in town. This week, I have raised my family's allocation and my company's allocation to sovereign debt. I'm merely sharing with you what I'm doing. Should you do it? It's your call. Alpha into omega or omega into alpha, it's a choice every trader takes for himself. So it's up to you. Friends, with this, I come to an end of my video. Thank you for your patience. Thank you for watching my video. Till we meet again in my next. This is Vijay Bhambwani signing off for now, not before reminding you to click like on this video and subscribe to my YouTube channel if you liked what you saw in the comment section. Please keep your feedback coming. And in the description below this video are hyperlinks to my playlist on Equity Masters channel, wherein I share a couple of ideas every week. Do subscribe to that YouTube channel as well. And there is a free trading guide hyperlink in my video. Do avail of that as well from Equity Master. I wish you have a very, very profitable week ahead, my friends. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.